Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my market insights for Tuesday, February 9th. The market's starting to get worried about the global financial system again. In particular, the European banking system is worrying people quite a lot. Since the beginning of last year, European bank stocks have done even worse than the oil and gas sector, which is saying quite a lot. Here, the yellow line is the value of European bank stocks relative to the Eurostoxx 600 index, while the blue line is gas and oil stocks relative to the same index. U.S. banks have underperformed the U.S. market too, as you can see here. The gray line is the U.S. banks versus the MSCI U.S. index, but European banks have underperformed their market even more, as shown by the blue line. European banks have underperformed U.S. banks as well. That's the gray line. One measure of the perceived risk in a banking system is the spread between LIBOR and the overnight index swap. LIBOR is the rate at which banks lend to each other, so it prices in the credit risk of banks, while the OIS is based on the rate at which banks can borrow from the central bank, and therefore is considered risk-free. So the LIBOR-OIS spread has widened out for both Europe and the US, but considerably more for Europe. Having said that, as you can see, it's still well below where it was in the crisis days of 2011 and 2012, so we're not yet at crisis levels, Europe-wide, that is. The European banking problem is centered in Italy, where there are concerns about the high proportion of non-performing loans. They're estimated at nearly 18% of total loans, which accounts for almost 30% of the Eurozone's total bad loans. Now, the country recently reached an agreement with the EU on creating a bad bank to handle these loans, but there are doubts about whether the agreement can actually be implemented. The issue is particularly important for Italy because Italian companies rely on bank loans rather than bonds for most of their financing, about 85%. Without a solution to the bad loan problem, it'll be difficult for the Italian economy to recover. You can see here how much worse Italian banks have done relative to their home market than German banks have. Having said that, financial stocks in Spain, Portugal, and Greece have done even worse than those in Italy. Greek bank stocks are down around 50% just this year alone, in a little over a month. Remember that even if a stock has fallen to just 2 cents, it can still fall 50% to 1 cent. The FX implications of this problem favor the dollar. This graph shows a financial conditions index for the Eurozone in yellow and the US in blue. Negative means tighter than normal conditions. You can see the financial conditions have become tighter in both regions. That's acceptable in the US because, after all, the Fed's tightening. But it's the opposite of what the ECB is trying very hard to accomplish. The ECB will have to intensify its efforts to ease financial conditions, and that's likely to be negative for the euro, or good for the dollar, whichever way you want to look at it. That response should revive the monetary policy divergence theme somewhat and send euro-dollar back towards 108, the bottom of its recent trading range, in my humble opinion. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.